Yeah. Yeah. So, good afternoon, friends. I welcome you to this third day of the company law refresher course, and we have completed 2 successful days, and we are right in the middle. 2 more days to go after today. I am fortunate to have with us today CA Preeti Savla, the immediate past chairperson of WRC, as well as the chairperson of this corporate laws committee. I am also having along with us my regional council colleague CA Drushti Desai. We have both the speakers today with us, CA Darshana Mankad and CA Anand Bathiya. Friends, the topic for the first session that are to be discussed are private companies, concessions under the Companies Act 2013. And the second part of that session is difference between private placement, preferential allotment, and rights issue. In the second half, Anand Bhai is going to take us through the topics of declaration of payment and dividend and the related party transactions. Friends, let me tell you from a practicing chartered accountant perspective, I feel all these topics are very, very relevant. When we talk of private companies, many times, we get confused or stuck as to whether a particular exemption or concession or a provision is applicable or is not applicable. And also when we want to issue shares to, let us say, one group of shareholders or one shareholder, then many times we get confused as to what is the way in which the allotment should be done, whether it is a private placement or a preferential allotment or a rights issue. And I believe this holds true even for a private company. So these are the topics that Darshana would be taking. And for Anand Bhai also, yes, declaration and payment of dividend, and especially now in this COVID-19 situation, many companies might be having losses, and still, whether they would be able to declare dividend and what are the ways in which dividend can be declared, as well as what are the rules relating to the bank accounts and all. And another very important topic that Anand Bhai would be taking is on the related party transaction. Very, very much under scrutiny of all the regulators, any related party transaction, and whether it is arm's length or not. And therefore, we have very competent speakers today, Darshana and Anand Bhai, to take us through these topics. I now would request Drashtiven to kindly give her opening remarks and also introduce Darshana. Drashtiven, please.
Yes. Thank you, Vishal Bhai. And it's really my privilege to introduce such a learned speaker for the event. I must say that we have very good topics, and it will immensely help the audience. And I'm sure this is going to be put up on the web, so it will be a good reference point even in the coming future. So with this, without wasting more time, I will first do my task of introducing the speaker for the first session, Darshana. So she is a fellow member of the Institute of Chartered Accountants, supported by bachelor's degree in commerce. She's a partner with KC Mehta and Company Chartered Accountants, Vadodara, and heads the corporate advisory practice of the firm. She has more than 25 years of rich industrial experience and was a part of top management team of a large listed company. She has handled diverse assignments ranging from setting up new companies, businesses, budgeting, project financing, fund management, and other finance-related functions during her employment. And she has successfully handled restructuring assignments, transaction support for mergers and acquisitions, entire setup of compliances for new businesses, regular compliances, consents, approvals for various types of entities and businesses. And she has also coordinated end-to-end execution of various assignments for companies, be it restructuring, joint venture, mergers, acquisitions, hand-holding, everything. So with this rich experience, we will have the speaker for the first session who will throw light on the topics, and they're very relevant, and I'm sure all of us will really benefit. Now I would request Vishal Bhai to take over from here. Thank you.
Yeah, thank you, Drushtiben. I also recognize the presence of the Secretary of WRC, CA Murtuzabhai Kachwala. And with this, I would request Darshana to kindly take charge of the session.
Yeah, thank you, Vishal sir. Thank you, Drushtiben, for the introduction. Uh, Thanks the WIRC team for recognizing me and making a part of this refresher course. I also acknowledge Anand bhai being with me, and I am sure we will have a lovely session sharing with him. Uh, I would just like to have a brief give a brief overview on what has happened on the Companies Act 2013. As we are all aware, the Companies Act 56 was in place since its enactment. This act was amended almost 25 times, and introduction of a revised legislation was required. Therefore, the entire act was amended, which got the President's approval on 29th August 2013, and Companies Act 2013 was notified in two parts, where few sections were notified on 12th September 13 and a few more on 26th March 2014, which were made effective 1st April 2014. In the Companies Act 2013, additional compliances were made applicable to private limited companies. There were comparatively a few compliances in the 1956 Act, but some more came in place with the introduction of Section Companies Act 2013. Due to this, it was difficult for private limited companies to manage their own affairs. Several representations were made to the Ministry of Corporate Affairs, and subsequently relaxations were given by the MCA to private limited companies, either by way of notifications, or there were maybe 3 or 4 which were already there in the Act. Primarily, a private limited company means a company which, by its articles, restricts the right to transfer its shares, except in case of one-person company, limits the number of its members to 200, and prohibits any invitation to public to subscribe for any securities of the company. These are the primary differentiation between a private limited company and a public company. In the ensuing slides, we shall go through the exemptions which are available to a private limited company. When we refer to Section 2, subsection 40, Section 2, subsection 40 refers to financial statement. So when we talk about financial statement with reference to a company, it includes a balance sheet as at the end of the year, profit and loss account for the financial year, cash flow statement for the financial year, a statement of changes in equity if applicable, and any explanatory note which forms part of any of the above 4 documents. So all the companies have to prepare these statements when they compile their financial statements. However, by virtue of the exemption given in Section 240, a startup private company is not required to prepare cash flow statement as a part of its financial statement. This exemption is available only to a startup private company and not to all private companies. When we move on to Section 2, subsection 76, clause 8, Section 276 primarily deals with related party. So as per Section 276(8) of the Act, any body corporate which is a holding, subsidiary, associate of such company, or a subsidiary of holding company to which it is also a subsidiary, meaning a fellow subsidiary, and investing company of that company, is considered as a related party, and transactions entered with such related parties attract the provisions of Section 188. Section 188 primarily deals with the compliances required to be carried out when the transactions are entered into between any two related parties. So 276(8) defines what is the relationship of that body corporate. According to Section 188, for all the other companies, the compliances as prescribed in the section have to be carried out for transactions done with holding company or subsidiary company or a fellow subsidiary. However, private limited companies have been exempted, and even if a private limited company carries out transaction with all the companies defined here, body corporate, which is holding subsidiary or an associate, this particular clause is not applicable to a private limited company, and therefore they are not required to comply with the transactions entered with these type of companies. We move on to Section 43 and 47 of the Companies Act, which speaks of kinds of share capital and the voting rights. As per Section 43, the share capital of the company shall be either equity capital or preference capital, which applies across. When we talk about equity share capital could be with voting rights or with differential rights as to dividend, voting, or as prescribed in the rules associated with this section. Now, when we go to Section 47, Section 47 specifies the voting rights available to a shareholder. So, there is an exemption given to private limited companies saying that Section 43 and 47 will not be applicable to a private company. So, what we mean by Section 43 and 47 not being applicable to a private company means that there are rules which are given along with Section 43 for differential voting rights, which would not be applicable to a private company. So a private company can frame differential rights which may be different than what has been prescribed under the rules. Similarly, a private company can also lay out in its articles that even if the preference shareholders are not paid a dividend for 2 years, they need not have powers or they would not be eligible to vote on all types of resolutions. When we look at Section 47, it otherwise gives a right to the preference shareholders to vote on all types of resolutions if dividend is not paid for a period of 2 years. However, if the articles of the company permits, then there could be a deviation and a private limited company can restrict such rights even to the preference shareholders if dividend is not paid by the company. So 43 and 47 can be utilized by a private company if they need different types of capital as a part of their structuring. We move on to the next section, which is further issue of capital, Section 62, subsection 1A, clause I, and 62, subsection 2. Section 62 primarily deals with further issue of capital. So what has been prescribed in the Act and the rules thereunder, that whenever a rights offer is made, the rights offer has to be kept open for a minimum period of at least 15 days after the offer is sent to the members, and the time limit for dispatch of notice to a member is a minimum of 3 days before the opening of the issue. So that means if you are sending a notice to the members, then that notice, the offer can open only after 3 days after the notice is being sent. That is one of the requirement. And the offer has to remain open at least for a minimum period of 15 days. By virtue of the exemption given to a private limited company, it is possible that the offer can be kept open for a period of less than 15 days, and the issue can also be opened within a period of 1 or 2 days after the notice is sent. However, there is a condition attached to it that the notice period or the time limits can be relaxed only if there is a consensus from at least 90% of the members. So before issuing the notice, consent has to be received from 90% of the members stating that they have no objection if there is a shorter notice. Similarly, the offer can be kept open only for something less than 15 days if all of the members amounting to 90% they give their consent in such a shorter duration. Taking forward same section 62, that is further issue of capital, 62(1)(b) deals with the offer of the shares to its employees. This offer to employees requires a special resolution to be passed by the company prior to making such an offer. However, in case of private limited company, there is no need to pass a special resolution, and a company can offer shares to its employees by passing an ordinary resolution. So the company need not comply with all the requirements of a special resolution, and by way of an ordinary resolution, they can offer the shares to their existing employees. We move on to the next section, that is section 67, which is restrictions on purchase of company of its shares or advancing loan for purchase of its own shares. So primarily section 67 is a prohibitory section, and it prohibits the company to purchase its own shares or advancing any loan for purchase of its own shares. However, private limited companies are exempt, and private limited companies can purchase their own shares if certain criteria are fulfilled by them. So when we talk about private limited companies which can claim such exemption, they can purchase their own shares if they do not have a body corporate as a shareholder. So it says it does not have any shareholder which is a body corporate. If the borrowings of such company from banks or financial institutions or any body corporate is less than twice of its paid up share capital or rupees 50 crores, whichever is lower, and such a company is not in default in repayment of any such borrowings subsisting at the time of making transactions under this section. What we need to note is that all the conditions mentioned here have to be fulfilled because the conjunction used is and. So the company should not have a body corporate as a shareholder. Then the criteria of borrowings also comes in, and they should not have defaulted in any of the repayment. So even if one of the condition is not fulfilled, the company does not have a power to purchase its own shares. The next exemption that we are going to talk about is acceptance of deposits from public. So Section 73 permits companies to accept deposits from public only in the manner provided by the Act. Section 73 subsection 2 clause A to E have laid down certain conditions which have to be followed for acceptance of deposits from public. Now, these conditions are that issuance of circular to its members, filing of circular with the registrar of company, depositing of a specified sum with the bank as deposit repayment reserve account, etc. So if a company has to accept deposits subject to whatever conditions, then they also have to comply with what has been laid down in clause A to E of subsection 2 of section 73. Now, these conditions of issue of circular or of depositing a specified sum with the bank as deposit repayment reserve account, these conditions are not applicable to private limited companies accepting deposits, provided such companies file the details of monies accepted to the registrar. As you all know, we have now DPT form which has to be filled in every year. So that is one of the conditions, that the form has to be filed, and on fulfilling the following conditions. Now, just to have a look at what are the conditions. A company which accepts from its members monies not exceeding 100% of aggregate of the paid up share capital, free reserves and securities premium account. So they can, a private limited company can accept once again only from its members monies which is not in excess of the aggregate of paid up share capital, free reserves and securities premium account. Or a startup company can also accept deposits for a period of 5 years from the date of its incorporation. Or a private limited company which fulfills any of the below mentioned 3 conditions can accept deposits, which says a company is not an associate or subsidiary company of a company if the borrowings of such a company from banks or financial institutions or any body corporate is less than twice of its paid up capital or 50 crore rupees, whichever is lower, and such a company has not defaulted in the repayment of such borrowings subsisting at the time of accepting deposits under this section. So once again here, only if all these 3 conditions are fulfilled, that is, it is not an associate or subsidiary of any other company, or the borrowings are not so the borrowings are less than twice of its paid up capital or 50 crore rupees, or they have not defaulted. So if all the 3 conditions are fulfilled, they can accept deposits from public, and they will still not have to comply with the subclauses A to E of subsection 2 to section 73. So what we need to note is that a startup company and a private company which fulfills the 3 conditions mentioned herein can accept deposits from its members without any limit. So in the first condition, it says that it cannot accept monies exceeding its paid up capital, free reserves and securities premium. However, as a part of the third condition, if all the 3 conditions, 3 sub-conditions are fulfilled, it can accept monies for which there is no limit laid down under the laws, and it is not restricted to paid up share capital, free reserves and securities premium account. Acceptance of deposits are very widely used by private companies, because in case if they need further capital, and if they issue everything by way of share capital, the money gets blocked, and as we all know, then the share capital cannot be withdrawn. But if deposits are taken, and if they have the liberty to take deposits, they can take short-term deposits or uh, as per their requirement, and repay as and when the uh, company is in a position to give away its debt. So planning of or acceptance of deposits under this scenario is very, very important. We all know that the word deposit itself excludes any deposit taken from its directors. And because that's not an exemption, but that's a general definition, it does not form part of this exemption. We can utilize these exemptions when we have to accept deposits from the members. This is a very advantageous tool when a company wants to get in some more funds for its business. Section 92(1). So section 92 deals with annual return, and subsection 1 of section 92 states that the annual return of a startup company shall be signed by a director, and a company secretary in practice is not required to sign the same. So as per section 92, in case of a one-person company, small company, and private company, which is a startup, the annual return shall be signed by the director. So there is no need of getting this document signed by a practicing company secretary. Once again, this exemption is also available only to a startup private company and not to all private companies. Now we have section 101 to 107 and 109, which deals with the how the meetings have to be conducted, how the demand for poll can come up. So these sections primarily deal with the management and administration of the company, which includes issuing notice for a general meeting, statement to be annexed to the notice, number of members who are required to remain present at the meeting, election of chairman for the meeting, appointment of proxy, or demand for poll, etc. So these sections have laid down the manner in which a company can conduct their meetings. There are regulations which say that a minimum of so many people should be present in certain type of companies. By virtue of the exemptions given to a private limited company, a private limited company can override these sections by amending their articles to ensure ease of compliance. Please note that their articles need to be amended appropriately. If the articles are silent on these sections, then whatever has been given in the Act will apply, and a private limited company will also have to follow the compliances as given under the relevant section. However, if the articles are so amended, then they can have the benefit of this exemption. Moving on to the next exemption that we have, uh, under section 1173G, a company is required to file certain resolutions with the Ministry of Corporate Affairs in form E-Form MGT 14. So the whatever resolutions are passed by a company under section 179(3) of the Companies Act, which includes buyback of securities, adoption of financial statements, investment of money, borrowing of money. So these resolutions are passed have been laid down in section 179(3). And once the board passes these resolutions, they have to be filed with the MCA in form MGT 14. Private limited companies are exempt from filing of these forms, the form MGT 14, when the resolutions are passed under section 179(3). See, MGT 14 is a form which has to be filed for any special resolutions that are passed. However, the specific exemption has been given to private limited company when any resolution is passed under section 179(3) of the Act, and not to all the resolutions which appear under say MGT 14. Then we go on to the relaxations which have been given to the auditors. Section 143 has cast the responsibility on the auditors to state in their report whether the company has adequate internal financial controls with reference to financial statements in place and the operative effectiveness of such controls. As you are all aware, IFC has become a very important tool, and even if the management is not supposed to report on IFC in certain cases, the auditors are bound to report about the internal financial controls which are being followed by the company, and also state whether the operating effectiveness of such control is in place. Not just reporting that internal financial controls are adequate, but also ensuring that they are in place. By virtue of this exemption, small companies, one-person companies, and company with turnover less than 50 crore or having aggregate borrowings less than 25 crores, auditors are not required to report about internal financial controls. Once again, this exemption comes with a threshold limit. So only such private companies are exempt. So auditors of such private companies are exempt from complying with this provision only if the companies do not fulfill the limits that we have stated. Only if its turnover is less than 50 crores and the aggregate borrowings are less than 25 crores. In case if the turnover exceeds 50 crores or the borrowings exceed 25 crores, the auditors of such private limited companies are required to report about the internal financial controls, and therefore the private companies also need to ensure that they have internal financial controls in place and that they abide by the IFC adequacy, whatever is required. So they ensure that whatever has been mentioned as internal financial controls are observed by them in their day-to-day working. We have section 149, which deals with constitution of the board of directors. So the constitution of the board of directors requires every listed company and a specified class of companies to appoint at least one woman director. So when we say specified class of companies, it deals with the turnover and the net worth and the capital of the company. Similarly, independent director is also required to be appointed by public companies which meet the threshold criteria laid down under the rules. However, the requirement of appointment of a woman director or an independent director is not applicable to a private limited company, irrespective of its turnover or capital. So the section itself speaks of a public company, and the thresholds are also applicable to a public company. Now, when we say public company, it is not necessary that it should be a listed company. if the public company, even if it is not listed, but they go beyond the threshold limits prescribed in the rules, they have to appoint a woman director or an independent director, whatever the case may be. Similarly, the way we have in section 149, section 152(6), subsection 6 is also, that also speaks of appointment of directors, and that is also applicable only to public company. So private limited companies, in whatever circumstances, they are not required to abide by these sections. So at every annual general meeting of a public company, 1/3 of the directors are liable to retire by rotation by virtue of what has been prescribed in the Act. This section does not apply to private company, and therefore the directors of a private company need not retire by rotation. Section 160, which is right of directors other than retiring directors. We all know that if a person has to be appointed as a director in a company, then either he himself has to propose his candidature, or some of the other member can propose his name to be appointed as a director. In such a case, the person himself or the member proposing him to be a director has to deposit an amount of 1 lakh rupees with the company and give a notice of 14 days, and only after his appointment the amount is refunded back to the person who has deposited the amount. So this requirement of depositing the amount of 1 lakh is not applicable for the appointment of a director of a private limited company. All other companies have to abide by these regulations, but a private limited company is exempted from depositing such an amount. When we talk of a private limited company, we all know that private limited company is normally either a family company or person come together who know each other quite well, and therefore all the exemptions which have been given to facilitate and give ease of business to small group of people, where the intention is very clear. And if in a small company, it may be difficult for them to, for following these regulations, they need equally competent person, and that may not be their business scenario may also not be permitting such expenses. And for ease of doing business, certain exemptions have been given to the companies. What we find in next section, that is section 162, where the appointment of directors to be voted individually. That is also just to ease out the operations. According to 162, section 162, a motion for appointment of 2 or more persons as directors of the company shall be moved at a general meeting unless a proposal to move such a motion has first been agreed. So a motion cannot be moved for appointment of 2 directors in a single resolution, 2 or more persons as directors in a single resolution. However, a private limited company can move such a motion in its general meeting, and it can appoint more than one director via a single resolution. We move on to the next section for meetings of the board. So section 173(5), subsection 5, it says, so we know that a company has to have at least 4 meetings in a year, and the gap between 2 meetings should not exceed 120 days. We have to fulfill all the requirements Earlier, we had one meeting in a quarter. That was mandatory. So now it has been changed that we need to have 4 meetings, but the gap between 2 consecutive meetings cannot be more than 120 days. So in this exemption, which has been given under section 173(5), startup private companies shall be deemed to have complied with the provisions of this section if they conduct at least one board meeting in each half of a calendar year, and the gap between the 2 meetings is not less than 90 days. In such a scenario, a startup private company has the exemption of not complying with the other requirements stating that there should be at least 4 meetings in a year, and the gap should be 120 days. So this is an exemption to that. But once again, this is only to a startup private company and not to all private limited companies. Taking the meetings forward, we have section 174 subsection 3, which speaks for quorum for meetings. So the quorum for a board meeting is 1/3 of its total strength, or 2 directors, whichever is higher. And in cases where the number of interested director exceeds or equals to 2/3 of the total strength of the board, the number of directors who are not interested, being not less than 2, shall be the quorum during that meeting. That's what the Act prescribes, that so the quorum is 1/3 of the total strength or 2 directors, whichever is higher. And if the number of interested director is more than or is equal to 2/3 of the total strength of the board, then the number of directors who are not interested and who should obviously not be less than 2 shall be the quorum during the meeting. Now, in case of a private limited company, the interested director can also be counted towards quorum, provided he has disclosed his interest pursuant to section 184. So if a director is already disclosed that he is an interested party or he is interested in some other entities, and then he can be considered as a quorum, and he can be concluded and he can be counted in the quorum which is considered for that meeting. Section 177 and 178. So 177 and 178 deal with audit committee and nomination and remuneration committee. Companies Act 2013 has casted certain duties on the audit committee, nomination and remuneration committee, and such committees have to be constituted by certain class of companies. The class of companies are defined under the Act, and they include only listed companies or public companies. So public companies which fulfill certain threshold of turnover, capital, etc. So per se, this section is not applicable to a private company, and that is how it enjoys the exemption. So irrespective of the turnover or threshold, whatever it may be, it is not just applicable to a private limited company. We move on to next section, that is 180, which gives restriction on the powers of the board. Section 180, I am sure we would be dealing with certain sections day in and day out. Section 180 of the Companies Act permits the board to pass certain resolutions only if the members have approved such resolutions. So the type of resolutions that we are referring to would be sale, lease or disposal of an undertaking, invest otherwise in trust securities, borrow money in excess of its paid up share capital, securities premium and free reserves. So such resolutions can be passed by the board only with the approval of its members. However, these restrictions are not applicable to a private limited company. As we discussed earlier, private limited company, in a private limited company, the directors and the members are normally not different, or they come from the same group or the same family. So such exemptions have been granted only from a practical perspective and to avoid the formality of obtaining the consents of the members, because members also would be directors. So instead of going into that formality, the private limited companies have been exempted from such approval. Section 185. Section 185 is also a much discussed section, and it comes even while auditing, we come across the applicability of this section. So Section 185 restricts the company from giving loan or guarantee to directors or to any person in whom the director is interested. So it's not only limited to directors, it's also to persons where the directors are interested. However, this section is not applicable to a private company if there is no body corporate as a shareholder in that company. It has not borrowed money from financial institution or bank or a body corporate exceeding twice of its paid up share capital or 50 crore, and there is no repayment default subsisting of such borrowings at the time of giving the loan. Once again, this is also applicable. If 185 has not to be applied to a private company has to fulfill all these three conditions and not only one or two. When we move on to section 188, that is for a related party transaction. 188(1) subsection 1 lays down that no company shall enter into contract with related parties except with the consent of the board. The second proviso to section 188(1) states that no member will vote on such resolution if such member is a related party. However, this proviso shall not be applicable to a private company, meaning that in a private company, the member can also vote on such resolution even if he is a related party. So if there is a scenario that there are only two directors and a transaction is proposed to be entered with a related party, and one of the director is a related party. So if that director cannot vote on such a resolution because it falls under section 188, then the resolution itself cannot be passed. And that is the main purpose of giving this exemption to a private company. And it states that a member can cast his vote even if he is a related party. We move on to section 196, 4 and 5. So section 196 deals with appointment of a managing director. In case of a private limited company, for appointment of a managing director or a whole-time director, shareholders' ratification is not required, central government approval is not required, Schedule 5 of the Act is not applicable to the appointment of managing director or whole-time director of a private limited company, and E-Form MR1 is also not required to be filed. So be it a public company or a listed company, appointment of managing director has to be done only in the manner prescribed under the Act, and shareholders also need to ratify. In certain cases, central government approval is also required. Their remuneration is also regulated, and the form has to be filled in for their appointment on the MCA. These compliances are not required to be done by a private limited company. Similarly, section 197, which is pertaining to overall maximum managerial remuneration, which can be paid in case of inadequate profits or inadequacy of profits. That also does not apply to a private limited company, and private limited company can pay remuneration up to any limit, irrespective of this section being in place. There are restrictions, as we all know, more particularly in case of public company and listed companies. We have section 203, which deals of appointment of key managerial personnel. So private limited companies are mandatorily not required to appoint full-time KMPs, that is a managing director or a chief executive officer or a whole-time director or a company secretary and a CFO. This is also to ensure that small businesses cannot take huge expenses and they can manage their business in their own way. Section 204, which speaks of secretarial audit. So secretarial audit is applicable only to such private companies which have outstanding loans and borrowings from banks or financial institutions of 100 crore rupees or more. So only such private limited companies which reach to this threshold will have to get secretarial audit done. All the other privately limited companies are not required to get their secretarial audit carried out. In addition to all these sections, Rule 10(1) of Companies Management and Administration Rules 2014 shall not apply to a private limited companies. Primarily, these rules state that not less than 7 days notice has to be given by way of advertisement in case of closure of register of members or deposit debenture holders or other security holders. So an advertisement is required to be given in a vernacular and an English newspaper before 7 days before the on the closure of the register of members or debenture holders. However, a private limited company is not required to give such an notice by way of an advertisement if, in any of the newspapers, be it vernacular or English. This is more relevant from public and all the more relevant from a listed company, because the closure of register of members has to be communicated on a public forum. We are done with the exemptions which are given to private limited companies. We will now move on to the difference between private placement, preferential allotment, and rights issue. So we all know that in case of if a company wants to infuse additional funds for their business, and it is not inclined to go for borrowings from financial institutions for reasons best known to them, they can do so only by way of further issue of securities. Now, the further issue of securities can be carried out by any of the following three processes. One is rights issue. When we say rights issue, what we mean is that in rights issue, primarily the offer of equity or preference shares is given only to its existing shareholders. So there are two things. The offer can be only of equity or preference shares for no other securities. Secondly, the offer can be made only to its existing shareholders and none else. When we move on to the private placement, in case of private placement, the offer of securities is made to a selected group of persons not exceeding 200. So here the range expands from the existing shareholders. In private placement, it is not the existing shareholders who are offered. but the offer is made to a selected group. Once again, it is not a public offer. It's to a selected group of persons, not exceeding 200. And the offer can be made of securities. When we use the word securities, securities means shares, scrips, stocks, bonds, debentures, debenture stocks, units, or any other instrument issued to investors under any mutual fund scheme. So the definition of securities is too wide. It is not restricted only to equity and preference shares. The third manner in which the funds can be raised is by making a preferential offer. So the expression preferential offer means an issue of shares or other securities by a company to a select group or group of persons on a preferential basis and does not include shares or securities offered through a public issue, rights issue, employee stock option scheme, employee stock purchase scheme, or an issue of say sweat equity shares or bonus shares or depository receipts issued in a country outside India or foreign securities. So this is also to a group, selected group or group of persons, which may include its existing shareholders. However, the offer is shares or securities, but that is not by way of a public issue or rights or bonus or ESOPs. Now, when we say the shares or other securities, this expression for the preferential offer means equity shares, fully or partly convertible debentures, or any other securities which would be convertible into or exchanged with equity shares at a later date. So this is equally important in case of preferential allotment. The type of security that you can issue is either an equity share or any other instrument which will be exchanged with equity shares at a later date. So it cannot be just any other, say a bond or something, which is not convertible into equity shares. These are the primary differences between these three types of issues. And for a better understanding, we have tabled it over here. So when we talk about rights issue, private placement or preferential allotment, the governing section for rights issue is section 62(1)(a). For private placement, it is section 42 read with rule 14 of the company's prospectus and allotment of securities rule 2014. Section 62 for preferential allotment, it is section 62(1)(c) read with rule 13 of the company's share capital and debenture rules 2014. Meaning, I'll just go through, but I think we have already discussed in detail. Rights issue is issue of further shares to existing shareholders in proportion of their existing shareholding. Private placement, it's offer or invitation to selected group of persons identified by the board and which will not include qualified financial institution or employees of the company. Preferential allotment can be done to a select group of persons, whether or not, and it can include its members and employees. The securities which can be offered is equity shares and preference shares in case of rights issue. Any securities including equity, preference, debentures under private placement, and equity shares, fully or partly convertible debentures or any other convertible debentures in case of preferential allotment. Just a second. Can I move to the next slide, please?
हेलो
Yeah, I have. Yeah, you.
मिश्रा
I
जी क्या
couldn't go.
हुआ?
नहीं, मैं जा पाई अभी. The allottees in the rights issue could be only the existing equity shareholders. Private placement, it could be persons identified by the board which shall not exceed 200 in a financial year. And in preferential allotment, it could be existing shareholders, employees, and any other persons identified by the board. Once again, not exceeding 200 in a financial year. When we talk about the offer letter, there is no prescribed format for the rights issue for the offer letter. Private placement form PAS4 has been prescribed, and preferential allotment also deals with the stipulations given under form PAS4. For a rights issue, a separate bank account is not required to be opened. However, under private placement and preferential allotment, a separate bank account has to be opened, and the monies received against the subscription has to be deposited in that separate account. Shareholders' approval is not required in rights issue, meaning a board can pass a resolution that they would like to call for additional share capital by way of rights issue and call the funds. But in case of private placement and preferential allotment, shareholders' approval is required in both the cases. Valuation report by a registered valuer is not mandatory in case of rights issue. So when the form is uploaded, we are not required to attach a valuation report to that. We have assumed that the shareholders are residents, because for non-residents, we also need to comply with the FEMA guidelines. And when we say valuation report, we are also not dealing with income tax on this platform. So if income tax may need a valuation report, that is something else. It's not dealt in with here. In case of private placement or in case of preferential allotment, so in both these cases, a valuation report by registered valuer is required. So in case of preferential allotment, valuation report may not be required for preferential allotment done by a listed company, because in case of listed company, the market itself will determine the price or the prevailing prices that are going on. Offer period in case of rights issue is minimum 15 days and maximum of 30 days. And as we discussed, in case of a private company, it can be reduced to less than 15 days with the consent of at least 90% of the shareholders. For a private placement, minimum period has not been defined. But in case of preferential allotment, what has been laid down is that the entire process of allotment has to be completed within 12 months from the date of passing of special resolution. So if the entire process as envisaged when the preferential allotment is offered does not get completed within a period of 12 months, then they have to start the process afresh, and they cannot carry that out on the earlier special resolution passed by the members. Mode of dispatch of offer letter. For rights issue, the offer letter has to be sent either by a registered post, speed post, or through any electronic mode to all existing shareholders, and they should be delivered before 3 days of opening of the issue. That is very important. In case of private placement, the offer letter will be sent in writing or in electronic mode within 30 days of recording the name of the persons, because it goes to a select group of persons. Once they have been identified, it is to be sent within 30 days. Preferential offer can also be made in writing or in electronic mode within 30 days of recording the name of the persons to whom it is going to be offered. So if employees and existing shareholders are a part of it, they will also form part of the entire list which is approved by the board, and the offer will be sent within 30 days of the recording of the name of the persons. Authorization of such issues in the articles of the company. So nothing has been specified as far as rights issue are concerned. Even private placement, there is no specific authorization required in the articles. However, in case of preferential allotment, the articles need to authorize that the company can get into preferential offer. Return of allotment. PAS 3 is required to be filed within 30 days of the date of allotment in case of rights issue. And both in case of private placement and preferential allotment, PAS 3 is required to be filed within 15 days of the allotment of securities and not 30 days as the time we have in case of rights issue. Disclosures in explanatory statement. In case of rights issue, we just don't have to go to the shareholders for their approval, and therefore disclosures in explanatory statement are not required. However, both in private placement as well as preferential allotment, disclosures are required as specified in the respective rules. So when we talk about private placement, it's Rule 14. And when we talk about preferential allotment, it is Rule 13 as well as Rule 14. So a company needs to comply with whatever has been laid down in Rule 13 as well as 14, and the disclosures are required to be made in the explanatory statement. In case of rights issue, right of renunciation is available. So even if the shares are offered to the existing shareholders, the existing shareholders have a right to renounce their shares in favor of somebody else. In case of private placement and preferential allotment, right of renunciation is not available because the entire basis on which the offer is made, that it is being made to a select group of persons who have been approved by the board. And if that right has been given to person X, then the X person does not have the right to renounce those shares in favor of Y if Y is not forming part of the list. So right of renunciation is not available in case of private placement and preferential allotment. When we talked about the opening of the bank account, so in case of rights issue, it is not required to open a separate bank account. So utilization of money is linked with the opening of the account, and the money can be utilized on receipt because there is no separate bank account. It's difficult to keep a track of the utilization of money because it cannot be tagged. However, in case of private placement and preferential allotment, because a separate bank account is opened, it is very convenient for a company to monitor the operations of those bank accounts, and money deposited in such account cannot be utilized until the return of allotment is filed. So if a company wants to utilize that money immediately on receipt, it will have to first comply with this section, file PAS 3, and only thereafter it can utilize the money. Till then, the money has to continue staying in that account and not utilized. The forms which have to be filed with MCA is Form PAS 3 in case of rights issue, Form MGT 14 for the special resolution, and Form PAS 3. We have just now we went through stating that PAS 3 has to be filed within 30 days in case of rights issue and 15 days in the other two cases. But the same form has to be filed. But in addition to this, whenever the resolution is passed, MGT 14 has to be filed for private placement and preferential allotment. Thank you. I think I have been able to give some insight on the areas which I have dealt with, and I hope things are better, clearer to you.
मिश्रा जी क्वेश्चंस हाँ
Yeah, so if one of the director wants to sell some of his shares to the other existing director, there are no forms which are required to be filed with the ROC. SH4 is the form which has to be signed by the transferor and the transferee. It has to be the consideration which is getting passed on will be mentioned on that SH4. The distinctive numbers, the ledger folio numbers, both the parties will have to sign in presence of a witness, and share transfer form, that is the stamp duty which is applicable. Stamp duty is as per that applicable state, that will have to be affixed when the form is given to the board or the secretarial department of the company for effecting the transfer of shares. In the ROC, only when the annual return is filed. So annual return filing is an annual exercise, and there it will appear that the shares have changed hands. Question 2 says, can outsider become shareholder in private limited company without becoming a director? And is there a limit on the percentage of shares he can buy in a private limited company? So outsider, what do we mean by outsider? Any person can be a shareholder in a private limited company, provided the other members also agree for his appointment. In case of a private limited company, only if you offer shares to somebody known to you, he can become a shareholder. He cannot directly apply or obtain shares. And there is no limit on the percentage of shares which anyone can have. But say if there's a private limited company where two friends have joined together and they are managing the business, then somebody can hold 76%, other one can be 24%, or both can have 50-50%. But then it should be very clearly spelled out as to how the company is going to be managed. So because if somebody has a 76%, he can have a majority stake, he can speak, or he can ensure, or he will try to establish his own way of working. So though there is no limit laid down by the act of holding shares in a private limited company or by a group of people, what we have noticed in general business is that be it 50-50% or be it whatever percent, the manner in which the board of the company will be managed should be very clearly laid down. Yeah, next question says, if the company is unlisted public company, but it is closely held by promoters, just like a family business, so whether exemptions to a private limited company can be taken for such company? No, see, it has to be a private limited company. Even if it is a closely held public company, these exemptions will not be available. So when we said private limited company, we have already laid down what is a private limited company. One is it has to use to reflect private has to be reflected in its name, and it has to restrict the rights to transfer its shares, and the number of its members cannot be more than 200, and it cannot invite public to subscribe to its securities. So only then it will be a private limited company. And there's a difference between closely held company and a private limited company. So it's not going to be possible that these exemptions can be extended to them. Can a private limited company file forms with ROC? No, the ROC form filing does not give any exemption to private limited. Whatever regulations are there, they apply to companies across. Board meeting quorum in private company will be considered based on shareholders agreement or as per Companies Act. So the quorum has to be 1/3 of the total constitution or two, whichever is higher. So I am not in a position to get how can there be an ambiguity. So it cannot definitely say that it cannot. So 1/3 or two, whichever is higher, will continue. In case if there is a shareholders agreement in place, the shareholder agreements can say that at least, say there are two groups who have come together, then they can mention that at least one from both the groups will be present. But across 1/3 of the total constitution or two, whichever is higher, will prevail. In case of a death of a director, the effective date of cessation will be the date of death of director and not the intimation. Because board resolution is only a formality of taking it on record. Please guide as to conversion of unsecured loan to the equity shares of the directors. So what I presume is that there are unsecured loans which have been taken from the directors, which are proposed to be converted to equity.
I'm busy right now in a webinar.
I think so. Okay, when we are talking of further issue of shares, so this is unsecured loan. What we say is that cannot fall under any of these. One is very clear that you can refund the loan, carry out the process of and we are telling equity shares of the directors. So okay, then it could be rights issue, that is also what you can do, but there is a process by which the unsecured loans can be converted into equity, where we say that the shares are issued otherwise than for cash. A resolution will have to be passed by the board. The person who has given the loan will also have to agree. A valuation will have to be done that at what value the shares will be allotted, and then the equity shares have to be allotted to the person who has given the unsecured loan. Next question says, in rights issue, if non-resident shareholder renounces his right in favor of resident person and issue value is same, whether registered valuation report required vis-a-vis 247 of the Act and section 62(1)(a). So in case of rights issue, valuation report from a registered valuation report per se is not required. Whether registered now in any case registered valuation report is required by a registered valuer. However, in case of rights issue, that is not required. The valuation report that we may need would only be to comply with the FEMA compliances, not with Companies Act compliances. Next question says, in case of death of shareholder, what is the procedure for transfer of shares to be followed in case of a private limited company, and any ROC form to be filed? No ROC form has to be filed. In case of a death, what we need to find out is first is whether the shares are held in joint names, whether there was a will in place. If there's a will in place, then it goes to the person who has been named in the will. If there's no will in place, the shares go to the second joint holder, and there is a form which has to be filed which says transmission of shares, and that has to be taken on record by the company. No ROC form is required to be filed. As in case of death, this will also get reflected. Sorry, as we discussed earlier, in case of transfer of shares by one person to another, it will also get reflected in the annual return, which is filed at the end of every year. Is it mandatory to obtain the valuation report from the merchant banker only for the rights issue of a closely held company? No. See, for rights issue, valuation report itself is not required for any type of company. When we were talking about rights issue or private placement, that was applicable generally and not only to a private limited company. So that is not required. Unlisted public company has not yet made the shares into demat form. The shareholders and directors are all family members and are applying to convert the company into private limited. Whether there is any penalty for dematerializing the shares of the existing shareholders. Ideally, the shares should first be converted into demat form, because right now they have not complied with the provisions. So when they will go for conversion, also they are likely to come up with these issues. So they should first get it converted into demat form and only then go to the regulatory authorities for conversion into a private company. If shares are issued to existing shareholders but offer is disproportionate to their existing holding, then it will be preferential allotment. What should be done is, if the shares are issued to existing shareholders, the company should offer in the proportion in which they are holding the shares. In case of rights issue, there is also a possibility of renunciation. So the offer can definitely give or lay down that the shares can be renounced to somebody. So, and the maximum shares that any person can accept would be so and so. So let the offer be in proportion to the existing holding, and then the acceptance could be disproportionate. I think if we are planning to structure it out, it can be done in that way. I hope I have been able to justify the questions.
Yes, yes. All questions are, और कुछ questions है कि बस हो गए हैं, इतने ही है?
हाँ मैम.
और है questions?
In case if you get questions even subsequently, you have my email ID. You can definitely share it with them.
Sure,
share it with me and I can respond to them.
Definitely, definitely. Sure, that is really great. Vishal bhai, I request you to please come online.
Yeah. Thank you, Darshana. That was really a very interesting session on the exemptions for the private company as well as the private placement rights issue and the differences and the procedural aspect. On behalf of WRC, I thank you for sparing your time and making a presentation for the benefit of all the members. Thank you very much.
My pleasure, sir. Thank you.
Yeah. Over to Preetiben.
Thank you, Vishal bhai. Thank you, Darshana Ben. I also request our regional council member, Yash, Umesh bhai also to join online. And we have our next session beginning now immediately. I welcome to all of you on this third day of our company law refresher course. And second session, first session is also completed in very much timely manner, thanks to Darshana Ben. And we have Anand bhai, our forthcoming speaker, who has joined since beginning of this third day of our series. So I welcome Anand bhai and friends. Related party transactions day by day becoming very important, and the disclosures are required. And we have to also mention, in case of listed companies and limited companies, you have to see that it is approved in the audit committee. And in case of private limited companies also, the importance of related party transactions, whether arm's length, not arm's length, is very important. Further, payment and distribution of dividend. Now, day by day, the various rule regulations are also changing. Earlier, the dividend was means with tax, without tax, and all. Further, with these new things, a lot of companies are also opting for buyback of shares. However, the importance of dividend is always there. So the entire procedure and about distribution and payment of dividend, as well as RPT, that is related party transactions, will be taken over by Anand Bathiya. So on behalf of participants, company law committee, and also WIRC, I welcome the speaker, C. Anand Bathiya, for the session. Further, I request CA Umesh Sharma, immediately past Vice Chairman, WIRC, to introduce him formally.
Yes, good afternoon, Preeti Madam, and thank you for giving me an opportunity to introduce a person who is happy in his name itself, Anand. In sir का जो biodata है बतिया sir का, he is a chartered accountant and a company secretary, and spreading the knowledge of company law to all the different sectors. He is a partner in Bathiya and associates, and a master having a knowledge of and advising leading companies negotiating for mergers, acquisitions, various IPOs, valuation issues, and as invited in national and international gatherings of Ministry of Corporate Affairs, CAG, ICAI, Institute of Company Secretaries, and various other different forums. And Anand sir is also a managing committee member of Bombay Chartered Accountant Association, and on the various committees of Chamber of Tax Consultant, and also on the WIRC's committees also. So he is a person who is spreading the knowledge, and as you must be seeing his face, a happy person. नाम में ही आनंद है सर, तो सभी पार्टिसिपेंट से मेरी प्रार्थना है और ये है कि आप भी सर का आनंद लीजिए, नॉलेज का आनंद लीजिए. थैंक यू.
Thank you very much, Umesh bhai, for your wonderful introduction to Anand Bathiya. I see Anand bhai in some very formal dress also in this lockdown period, and I see some difference in his face also. I don't know because of this online mode, but something difference is there. So let us hope that difference and all his knowledge, let us enjoy. Anand, so please over to Anand.
Thank you, Preetiben, for the kind words. Maybe it's the haircut or the lack of haircut because of lockdown. That's maybe making you feel so. But delighted to be here. Thank you, Umesh ji, for the kind introduction and translating happiness into a more local for vocal language of Anand. So happy to hear that. I think never did we imagine that 400 plus participants could be on a company law refresher course, that too sitting in our homes or maybe in some outside Bombay locations, maybe at their offices as well, but doing remotely. And all congratulations to WRC, Vishal Bhai, Drashti Ben, Priti Madam, all office bearers for transitioning so effectively into this online mode. And more power to all of you all at WRC. Also, the work from home guide that has been released by WRC is really insightful, and it really helps in terms of transitioning into the digital divide that we are all going through. I hope my presentation is visible. I have shared my screen, and what Vishal Bhai has told me to speak on is two aspects under this entire gamut of company law that we have been doing over this week. The first one is dividend, and the second one we'll talk about related party transactions. And both of them are very relevant in terms of what we do as chartered accountants, while some of the other areas of company law may not be so commonly used maybe by chartered accountants, and even some other professionals may have their domain in. But clearly, when it comes to dividend related party transaction, there is an element of finance, tax, and calculations as well. And that is where the professional brothers at chartered accountancy are also best equipped to deal with some of the issues in these two areas. So friends, over the next 1 hour 15 minutes, we will first go through dividend, and then we'll talk about related party transactions. And any questions, feel free to posting them, and at the end of the session, we will cover those questions. I also have certain questions which are inbuilt into the presentation, and hopefully some of your questions may be answered when we discuss those FAQs. So friends, let's talk about the dividend aspect and what does company law say as far as a dividend is concerned. So dividend is a fairly well-established, well-settled concept, and all of us are aware that a company is a vehicle where people come together to do a business. They have limited liability, and whatever they earn, the company will distribute to the shareholders in the form of dividend. Now, as far as the Companies Act is concerned, you have section 123, a very simple section to remember, 123 of the Companies Act, which deals with the provisions of dividend. Not many sections are there in the dividend provisions. 123 happens to be the main section of a dividend. What it says is that a company can declare dividend out of one, profit for the current year. So if I want to declare dividend, I can declare dividend of profit for that financial year, or it can be accumulated profits for the previous year as well. And third is both. Now, friends, the important distinction over here to understand is that when we are talking about profits and surplus in profit and loss account, it is slightly different from reserves. And you would have heard this in this refresher course, that reserves and surplus, though commonly used, are slightly different from a Companies Act perspective. So dividend prima facie can be declared from profits of current year or profits of previous year, or a combination of both of them. Friends, you would recollect that in the past, there was a requirement that a certain percentage of each year's profits were required to be transferred to general reserve. Companies Act 2013 came, and that requirement of mandatory transfer to reserve was done away with. No longer there is a requirement to transfer surplus of profit and loss account into any category of reserve. You can voluntarily choose to transfer to general reserve, but it's not mandatory. Now, if you have some old general reserve, or if you have voluntarily transferred some amount to general reserve, then dividend can be declared also from that free reserve. Free reserve is defined under the Companies Act. It's a slightly circular definition. The section of dividend says that dividend can be declared from free reserves. The definition of free reserve says that whatever is eligible for paying dividend is a free reserve, and it has 2 additional points. But free reserve is basically reserves which are not earmarked for a particular purpose. Security premium, share premium, is it a free reserve? No. Capital reserve, capital redemption reserve, is it a free reserve? No. Hedging reserve that comes in IFRS or Ind AS, is it a free reserve? No. So predominantly free reserve is your general reserve or other equity as it is normally known in the IFRS world. So if you don't have surplus in profit and loss account, you can also consider declaration of dividend from your free reserves. However, there are certain conditions to that, and we will discuss those conditions. There is also a concept of interim dividend. Now, as Madam told in the earlier session that companies need to do an annual general meeting at every year and discuss the performance, the financials, and a mandatory part is also declaration of dividend. So typically the board would recommend and members will approve what is the dividend. That dividend which is declared in the AGM is known as a final dividend for a particular year. Sometimes companies may not want to wait till the AGM, but want to declare dividend in the interim between the year or after end of the year. Now that is also possible, and Companies Act allows that the board of directors, without waiting for the AGM, can declare dividend, and dividend can be paid to the shareholders by a board resolution. You would have seen that all of the chartered accountants and Finance Bill 2020 abolished dividend distribution tax. And from 1/4/2020, you don't have dividend distribution tax, but dividend gets taxed in the hands of the shareholders. Lot of companies declared dividend in February and March. Maybe that was a better tax profile for them or out of a general requirement. All the dividends declared by company in the month of March, February were nothing but interim dividends because it was done without a shareholder's blessing. It was done at the board meeting, and hence it was an interim dividend. Now, if you have enough profits, you can certainly declare interim dividend. But if in the current financial year, that is in the year in which you are declaring dividend, you need to calculate until the end of the previous quarter. And if until the end of the previous quarter, you don't have a loss, you can go ahead and declare interim dividend. But if you have a loss in the quarter or until the quarter before you declare interim dividend, then your interim dividend will be capped on an average that is linked to your last 3 years dividend track record percentage. So the idea is that if a company is doing good, it is making profit, give them the flexibility to distribute dividend. But if it is loss making, which typically means that you have liabilities and payables as well, please don't allow shareholders to take home their money in a loss making company, but rather stick money in the company and pay off the liabilities. So that's a little bit of check and balance in terms of declaration of interim dividend, and one needs to keep that in mind. You can't declare dividend, friends, if there is a failure of section 73 and 74, which is basically the public deposit and acceptance of deposit schedules. So if you have defaulted on repayment of public deposits or payment of interest thereon, then until such time that default is not cured, you can't go ahead and declare dividend. Again, it goes down to the root of the Companies Act or the root of a liquidation preference that all surplus first goes to secured shareholders or secured creditors, then it goes to unsecured creditors, then it goes to preference shareholders, and then last is available to equity shareholders. So if dividend is declared, it kind of cuts through this liquidation waterfall, and therefore, if you have not paid these unsecured public deposit holders, you can't declare dividend to equity shareholders. In 2018, friends, The Companies Act was amended in February 2018, and they brought in a proviso. We saw that dividend can be declared out of profits for the current year and of the previous year. Now this profit, they brought in this proviso that when I am computing the profits, any amount that is represented by unrealized gains, notional gains, revalue of asset, or any fair value adjustment should be excluded. Now, we all know that from a reserves perspective, it is very clear what is free reserve and what is unrealized reserve, notional reserve, revaluation reserve. But this concept applies to profits for the year. And this is creating a little bit of a complexity when companies are calculating their profits for the year, because the words unrealized gains, notional gains, fair value are the new norm under IFRS or Ind AS. Someone can even argue that if I have sold a particular product as a part of my revenue or my sales, and I have not received that money or cash flow from my debtors, and the debtors are outstanding, it may still be unrealized because I have not realized. Or Ind AS requires me to mark to market my mutual fund investment. Now that may be a notional gain or a fair value gain. Now, do I need to adjust amounts that are flowing from my P&L to my P&L surplus is where the complexity is coming in. The idea, of course, is not to stop some of these accounting related matters of fair valuation or unrealized, but the idea is that if at all it is just a book entry, then make sure that you don't declare a book entry out of those kind of notional entries. But if you have cash that is represented, then by all means go ahead and do that. We saw that dividend can also be declared from reserves in the event that there is no surplus available for a particular year, or even if there is no surplus accumulated, then I can dip into my general reserve to declare dividend. What are the conditions? First, the percentage of dividend that I am declaring from my general reserve should not exceed the average of the last 3 years. Now, question comes, what if I have not declared dividend in the last 3 years and I want to dip into my general reserve? If you have not disclosed in each of the 3 years, no problem. This condition doesn't apply to you. If you have done it for 2 out of 3 years, you will still need to calculate average and declare only up to that percentage. The dividend that you declare should not exceed 10% of the paid up capital plus free reserves. So that is a cap. And third, the balance of reserves, that is after you declare dividend, you will still have the free reserves which are there. That shouldn't fall below 15% of your paid up capital. So they have made it slightly more difficult. There are checks and balances when you have to declare dividend from your reserves. So which is where if a company has a surplus of profit and loss account of, let's say, 200 crores, and a company has general reserve of 200 crores, it will be that much more difficult for the controlling shareholders to remove the 200 crores from the general reserve, as maybe it is that much more easier to remove from the surplus in P&L account. So that is where after this mandatory requirement of transfer to reserve was done away with, you don't see many companies transferring funds to general reserve, but they would rather keep them as surplus in profit and loss account, thereby giving them a higher flexibility in terms of the dividend that can be declared out of that. So this doesn't apply, as we spoke, if I am declaring dividend from my surplus in profit and loss account. Friends, what's the process? We understood how much dividend can be declared, from which reserves I can declare. Now, how do I declare dividend? First, the board needs to recommend dividend. Mind you, we are talking about final dividend. Final dividend, the board can only recommend. And ultimately, it is the members who need to take a call whether dividend can be approved or even dividend can be rejected. There are hardly any instances, but there are instances where in an AGM, the members have voted that they don't want to take dividend, and dividend has not been paid by the company. After the dividend has been approved by the members, within 5 days, the amount of dividend needs to be transferred to a separate bank account. So you go to a bank, open a separate bank account, and transfer the amount of deposit into a separate bank account from the date of declaration. It's important that dividend has to be in cash only. Question used to come that, can I distribute something else as dividend? Can dividend be in kind? Can I give any kind of other debentures as dividend? Dividend has to be in cash only, and it cannot be in kind as per Companies Act. Now, the entire process of payment of dividend from the date of declaration needs to be completed within 30 days. If dividend is unclaimed or unpaid, for example, I gave a check and that check came back, or it was an RTGS transaction and it didn't hit the bank account, then within 7 days, I need to transfer that unpaid dividend into a separate bank account. This is a different bank account than the bank account that we spoke in point number 3. This is an unpaid dividend bank account. So I transferred 5 crore rupees as dividend. 50 lakhs was coming back, and there were no shareholders. They didn't have their residential addresses. Their bank account details were wrong. And that 50 lakh rupee I will transfer to a unpaid dividend account. Within 90 days, after I transfer to that unpaid dividend account, I will prepare a list as a company that Mr. A, so much of dividend is unpaid. This is the address, this is the name. And I will have to put it up on my website that this is the details of unpaid dividend. Now, this is one leg of compliance that is not the best in terms of getting it done. If you have a website as a company, it is mandatory to upload this unpaid dividend statement on your website. If 7 years go and the shareholders don't come to you, if any of the shareholders come to you and say, look, you had declared dividend, but at that time bank account was wrong, here is my correct bank account, you will have to make sure that you transfer the dividend to him after doing your processes. But if for 7 years, no one comes to you, the entire sum that is lying in that unpaid dividend account will be transferred to Investor Education and Protection Fund. We are aware about Investor Education and Protection Fund. It's a government fund which is used for investor education and protection. So once declared, for all purposes, company cannot take benefit of the dividend. Either it will go to shareholders or it will go to IEPF at the end of the day. In fact, even shares on which dividend consecutively outstanding for 7 years, those shares per se will also need to be transferred to IPF. Not something that is concerning dividend, but since we are talking about IPF, it was important to take this point as well. Friends, as chartered accountants, we know that dividend distribution tax, DDT, was abolished, and now the shareholders in their individual hands need to pay tax on the dividend that they get. There is also withholding tax, or TDS, that has been brought about by the Finance Bill 2020 under Section 194, and TDS needs to be deducted by the company at 10% on dividend payments that are more than 5,000 rupees. Now, this is something that as companies will have to do an additional leg in their process, because they will need to know the PAN card of the shareholders, and it becomes slightly more complex if you have multiple foreign shareholders, because the tax law says that it has to be your TDS rate as per the Income Tax Act or as per the Double Taxation Avoidance Agreement. Now, let's say as far as US is concerned, the treaty says 15% is the withholding taxes. Or if it is United Kingdom, it may have a different withholding tax, or Mauritius may have a different withholding tax. I may also need to make sure that my shareholder is actually a tax resident of Mauritius, UK, or US. So this is one of the problems or challenges that listed companies are now tackling, so that when they declare dividend in August or September, they have data of their shareholders available. They know which country they are residing at, and accordingly they can map the TDS, and then this withholding taxes will be paid by the company on behalf of the shareholders. The shareholders will get credit of that in their individual tax filings. So friends, I have built about 12 questions. I would have loved to make it interactive, but you guys, wherever you are in whichever part of the state, country, city, just try and answer for yourself and see how many questions from these 12 questions are you able to solve properly. And that would mean that we are broadly aware with the dividend provisions. So question 1, and the 6 questions or first slide is equivalent to CA inter examination, and the second slide slightly difficult set of questions which is CA final examination. And let's see how many of us pass inter and how many of us pass the final examination. So question 1 is whether dividend can be paid on preference shares or to preference shareholders. So there is generally a thought process that whether there is interest payable on preference shares or there is dividend payable on preference shares. Now clearly on preference shares, yes, dividend is payable. Also the regulations that we saw, the caps that we saw, the process that we saw is similar in terms of equity shareholders as we saw for in the earlier slides. By their nomenclature, preference shares have a preference to equity shareholders. Now, is that preference only if the company is getting liquidated, or does this preference also apply to dividend? So if a company is liquidating, first it will go to secured creditors, unsecured creditors, statutory authorities, preference shareholders, and equity shareholders. But can I declare dividend only to my equity shareholders and not declaring it to the preference shareholders? Now, Companies Act says that the preference is in both liquidation and dividend. So if you have got this right, you get a second point in this. This is a simple one. Whether dividend can be declared out of securities premium? Clearly no, it is not a free reserve. You can't declare dividend out of security premium. Whether dividend can be declared out of capital reserve? Answer is no, it's not a free reserve. It's for a particular purpose, or it's on account of a unrealized amalgamation, or maybe on account of a redemption, and you can't use it for declaration of dividend. What will be the proportion of dividend in case of partly paid shares? So let's take a situation where I have a 10 rupee share and some shares are fully paid up and some shares are partly paid up. If I declare dividend of 5 rupees per share, then do I need per share means to every shareholder, or per share means per share in the proportion of their partly paid up percentage? The answer is the second one. We have to see in proportion of their partly paid up percentage. So dividend of 5 rupee will not be completely given if it is partly paid up, and only proportionate dividend will be given in case of partly paid up shares. We saw that within 5 days of declaration of that dividend, it needs to be transferred to a unpaid dividend account. Now, whether that there is a typo there, it is 5 days. So whether that 5 days is from the date of board meeting or from the date of AGM. Now, the guidance here is that if it is interim dividend, the so-called declaration has happened in the board meeting. So within 5 days of the board meeting. But if it is a final dividend, the board has not declared. The board has only recommended, and the members have actually declared. So then the 7 days starts from the 5 days starts from the general meeting. The second set of questions, and a slightly typical one, whether company can declare dividend and adjust the partly paid up amount that is outstanding from the members. So we talk about a situation where there is 5 rupees paid up and 5 rupees is unpaid. It's a 10 rupee face value share. So I, as a company, have to get 5 rupees from my shareholders whenever I make that call. Now my business is doing good. I don't need that 5 rupees and I have surplus money which I want to declare as dividend. Now first I declare dividend and then get 5 rupees from that shareholder. Can I not adjust it that the dividend is not payable and I make the partly paid up share fully paid up? Answer is yes. It says that dividend can be paid in cash or can be adjusted against the partly paid up that is outstanding from the members. So 123 section is an important guidance in this. Can a section 8 company declare dividend? Section 8 company is equivalent to the section 25 company which is not for profit. Now this company is for social cause, for a particular group of people, but not for profit. Can it declare dividend? Answer is no. In fact, one of the conditions for getting a section 8 license is that it cannot declare dividend, should be as a part of your memorandum and articles. Ind AS stretches from this argument and says that if I as a company own shares of a section 8 company, I will not consolidate that entity, because I can consolidate an entity only if I'm exposed to profits or dividend out of that entity. Now, if a section 8 company cannot declare dividend, I cannot say that that money belongs to me, and thereby a parent company will not consolidate a subsidiary that is a section 8 company. Differential voting rights. Maybe this has been covered in one of the sessions or maybe covered now, but can there be a differential DVRs or differential voting rights? Can I have differential rights to dividend? That a shareholder class A will get dividend of 10%, a shareholder class B will get 50% as compared to shareholders of class A. Is that possible? From a Companies Act, it is possible. From a SEBI perspective, which is the SEBI listing obligation and disclosure requirements, they say that differential should only be in relation to voting, and you cannot have differential inferior or superior as in relation to dividend. Can right of dividend be waived off? In a listed company, can I say that I don't want dividend? Or can 5 shareholders out of 500 say that yes, we don't want dividend? Answer is yes. And there are companies as we speak that have given waivers, or before they declare dividend, they give a form where shareholders can give their waivers, and if someone doesn't want, that can be waived off. You can see the notices or sections of Hero Motor Corp or even Sun Pharma or one of the Bajaj Group companies where there is provision where dividend can be waived off by a shareholder if you feel that you don't want dividend from that company. Is it necessary that interim dividend also should be paid to preference shareholders? We saw that preference shareholders have a preference in dividend as well. Now, if I am declaring on an interim basis, is there a requirement to first give to preference shareholders? The answer is no. The interim dividend is not something that is finally done. You will have to catch up to the preference shareholders only at the end of the year. You are free to declare interim dividend without payment to preference shareholders as a part of Companies Act. Last question. Can interim dividend be paid of free reserves of the previous years? We saw that dividend can be paid from the profits or from the free reserves of the previous year. Now, I'm not declaring a final thing. I'm declaring an interim dividend. And declaration from reserves has those conditions, 10%, 15%, etc. Can I declare an interim dividend out of free reserve? Answer is no. Interim dividend can be declared only out of surplus in P&L, both current year as well as previous year, but you cannot go into free reserves for declaration of interim dividend. So I hope we have been able to make some sense of the general complexities and guidance that is there around payment of dividend. It's a fairly simple structure that ways, but technically there are some issues and nuances that one needs to be mindful of. We will go to the next part of my discussion, and we'll spend the next 40-45 minutes on related party transactions. And in recent times, related party transactions has been really on the focus with a lot of companies falling on the wrong side. ILFS, we had Fortis Hospital and various others where there have been lapses in terms of related party compliances. Friends, if you see the regulatory framework today for related party transactions in Companies Act, then you have SEBI, you also have accounting standards, and all of that, there's a lot of regulatory guidance around related party transactions. You know that there is an ease of business doing rankings that the World Bank gives to every country in the world. There are about 190 countries, and India ranks somewhere in the 60s in terms of the rankings. Now, that number of 63, which is India's rank, has various different parts, and 63 is an average of those different elements that go into a ranking. One of the ranking is protection of minority investors. In that, related party rankings are given for every country. Now, you will be surprised to know that India ranks 4th across 190 countries in terms of the related party transaction, that framework that we have over here, and 13 in terms of protection of minority investors. So some of the regulations that we have around related party transactions are sort of best in class, maybe even an overkill for some of the companies, but clearly there is guidance and framework for related party transaction which may not be there even in most of the developed countries of US or UK. So what is the related party regime in India, and why is it so important? I think it's important first to know that what relationships are covered under related party. If you ask generally, all of us are related, right? If you go to Manusmriti, there was one gentleman, and all of us are offshoots of that one particular gentleman. So does it mean that all of us are related parties? No. There are certain set of relationships that only cover related parties. Not all relations are related parties. So there is a little bit of guidance in terms of what relationships or who are related parties that we will discuss. After that, not all transactions with those parties are covered under related party transaction. Only certain transactions which are listed in various statutes are covered under related party transactions. And the third is the framework of compliance. So first we need to see whether a relationship is covered. Then we need to see whether transaction with that relation is covered, and basis of that transaction there will be compliances. And so there is no one set of compliances that applies to every transaction with every related party. And that is where it creates a bit of complexity, that whether I need to take an audit committee approval in this, or whether I need to take a shareholders approval in this, whether majority of minority will be there or not. Or in the previous session, madam told us that for private limited companies, there are separate exemptions. So since it has evolved over some time, there are different relationships, different transactions, and accordingly, we have to be mindful of the compliances. Now, related party is across the gamut of what we do. In income tax, we have definition of relatives. We have section 56, which has gift in terms of relatives. Transfer pricing, we have the concept of associated enterprises and how the pricing needs to be between two A's. Goods and services tax, we have related parties. In the customs rules, we have related parties. On the commercial law side, in Companies Act 2013, we have related parties, of course, and we'll talk about that. Similarly, in the accounting standards, which are also a part of Companies Act, there's a lot of guidance of related parties. And for listed companies, which is the SEBI framework, there is a separate guidance of related parties. You have Insolvency and Bankruptcy Code, the other SEBI regulation, and Competition Commission of India. All of these have a different way how they define relationship, how they define transaction, and what are the compliances. What we will focus today is on Companies Act 2013. We will include some elements of accounting standards and some elements of SEBI. But predominantly, we will focus on the related party regime surrounding Companies Act 2013, especially section 188 of the Companies Act. So we'll start with who are related parties. Now, the Companies Act 2013 has a very specific definition of who are related parties. You can go to section 2, subsection 76, which will give you a list of parties, and those parties are related parties. Ind AS 18 or Ind AS 24 also doesn't have any principle-based definition. SEBI LODR doesn't have any principle-based definition, but is a very specific definition. But our accounting standard 18 is the only animal that is giving a principle-based definition to related party. And it says that parties are considered to be relative if one party has an ability to control or exercise significant influence. So if I can control you, or if I can exercise significant influence over you, then yes, you are my related party. And that is how they have tried to principally define. If you go into who is a relative, now the Companies Act requires us to first decide that who are my relatives. And from relatives, I can go to defining who are my related parties. Because related parties also include your relatives in certain situations. For example, key managerial personnel is a related party, but relatives of KMP are also related parties. So definition of relative 277 includes these elements as far as the Companies Act is concerned. The old act had many other relationships, but this is a fairly concise definition. Important over here is members of HUF are also covered in definition of Companies Act 2013, and stepmother, father, brother, sister are also in the definition of Companies Act. SEBI LODR, it has no separate definition. It piggybacks on our Companies Act definition, and these relations are also relatives as far as SEBI is concerned. If you go to Accounting Standard 18, it only covers 4 relationships: spouse, son, daughter, brother, sister, or father, mother. And it is a further caveated definition that if amongst these relations also you are not significantly influencing their dealings, then they are still not a related party. So 2 brothers who may not be influencing each other may still not be a relative under AS 18. Though under Companies Act, the earlier definition, we don't have a caveat of significant influence in dealings. But in AS 18, we have a caveat of influencing the dealings. Ind AS 24 is an inclusive definition, and it also includes domestic partners. Now, as you would assume, Ind AS is taken up from IFRS, and apart from spouse, you may have different relationships at your home. So domestic partner is also a feature that comes into Ind AS 24, and dependents of that person or of your domestic partner are also a part of your relative. So relatives are individuals, and from relatives, we develop the definition of related party. Friends, SEBI requires that every company should maintain a list of related parties, and listed companies would need to regularly update that particular list if there is an additional relative or an additional related party. So these definitions go into building up that list of relatives and related parties. Companies Act 276 covers relationships which are known as related parties. You have director and his relative. Now relative over here, you need to see the definition of Companies Act of relatives. A key managerial personnel, a partnership firm is also my relative if my director, manager, or relative is a partner in that firm. If it's a private limited company in which a director or manager or relative is a member or director. Friends, the word or is important over here. If you are talking of a private limited company, if my director is a member or a director there, it will become my related party. But if you see the next definition of public company, it is director and holds 2% of its paid up share capital. So if it's a public company, I have a higher threshold for it qualifying for my related party. If it's a private limited company where my director is a director or a member, it de facto becomes my related party as per Companies Act. There is a catch-all definition in the sixth one, which says that any body corporate whose board of directors are accustomed to act in accordance with the advice directions of my director or my manager. Now, accustomed to act is where the catch-all provisions come in terms of if any other body corporate is accustomed to act basis of instructions of my director, then he is my related party. Very difficult to prove, but unlike how these laws are drafted, including some of our tax and GAR provisions, this is a catch-all generic provision of accustomed to act. There are some other coverage of related parties as well. It includes holding company, subsidiary company, my parent company is KMP. We can go at peace. We don't have to spend time on this, but 276 is important in terms of who related parties are, and all of you all can at peace go through that. Key managerial personnel or KMPs includes the CEO, MD or manager. As we know, company secretary, whole-time director, and CFO is also a KMP. SEBI doesn't have any definition of related party. It says that whatever the Companies Act is saying, whatever the accounting standards say, and if a company or a person is holding more than 10% of promoter group, then also it is my related party. So definition is slightly more in SEBI, where it covers Companies Act, accounting standards, plus this promoter requirement when you are deciding as per SEBI whether a company is a related party or not. AS 18, we will not go through the language. All of us will have AS 18 and we can go through. But the point over here is that AS 18 is a specific definition only on these 5 type of relations. It further excludes. It's a very narrow definition. We saw that even the definition of relative is narrow in AS 18, and also the definition of related parties is now very narrow in AS 18. And in Companies Act, we have key managerial personnel. In AS 18, we have key management personnel, which is a definition and not the list of people that we saw in the Companies Act. This is a more defined, and you need to make sure that who your KMPs are. Similarly, Ind AS 24, a fairly elaborate definition. It goes into members of the same group as well. And group is defined only here in the Ind AS scheme of things, which includes parent, subsidiary, and fellow subsidiary. So you started with relatives, we went to related parties, and then we need to see which transaction are covered. If a director is offering his services without any consideration, is it a transaction that falls under related party transaction? Or if it is a loan that is given by a director or a related party to a company, is it a transaction that's get covered? So section 188 is the Bible as far as related party transactions go in Companies Act. And section 188 says that it is only this 7 type of transactions which are covered under related party scope of section 188. If there is any other transaction, 188 is not attracted. SEBI is different, accounting standard is different, but we are talking about Companies Act, where it is only sale, purchase of goods, selling of property, leasing of property, rendering of services, appointing of agent, place of profit or managerial remuneration, and underwriting of securities. So something like a loan to a related party or a loan from a related party wouldn't get covered in section 188. Maybe because it is covered in 185 or 186, but clearly only these transactions with the parties are covered under 188. Apart from this, there is one more section which is 177, which is the audit committee approval. Now friends, as far as if your company has an audit committee, then all related party transactions, just not this 7 that are listed in 188, but all related party transactions should go to your audit committee first. Now, the guidance in 177 read with the rules says that if an audit committee does not approve a transaction, it shall make its recommendations to the board. Now, other than those covered in section 188, so 188 transaction certainly go to the board. But if there are transactions which are not covered in 188, and if the audit committee feels that these are not to be approved, then it will go to the board that audit committee has recommended not to do this, and the board will finally decide. So 188, these 7 transactions straight away go to the board. If other transactions, only if the audit committee rejects, does it go to the board under section 188. There can also be omnibus resolutions which can be passed by the audit committee. So sometimes business is so flexible, fungible, and you may need the flexibility to deal with related party transactions in certain situations. So there is a possibility where you can, at the beginning of the year, give a limit to management that go ahead and do transactions with A, B, C, D party up to 1 crore rupees annual year. And then the management is free within that limit to go ahead and do transactions without taking a prior approval of the audit committee of the board. Now, this annual basis is where this omnibus resolution is valid. After 1 year, you'll again need to make sure that you take a fresh omnibus resolution. Question is, if a transaction is between a parent and it's wholly owned subsidiary, then is it required to have an audit committee approval or a board approval? Now, it is not required for audit committee other than for transactions under 188 again. Because if transactions are under 188, it will still need to go to audit committee despite it being between the parent and the subsidiary. In each of these 7 category of transactions that we saw under section 188, this go to the board. Now, from a board, if they are beyond a particular threshold, there is a monetary threshold, then it has to go to the members for their approval. And when the members will vote in that resolution, the interested related parties cannot vote in that resolution. This is not applicable to private limited companies, which we saw in the last session. But in all other companies, it will have to be voting by what is known as majority of minority. So minority shareholders will have to decide whether this transaction can be done with a majority related party or not. And in each of these 7, there is a threshold. For example, let's say F, appointment of any officer to the place of profit, or appointment of any individual to the place of profit. Now, if I am paying a monthly remuneration of more than 2.5 lakh rupee per month, the board will have to mandatorily make sure that it is a members resolution that approves that and not otherwise. So this is where there are thresholds available there, and these thresholds are available under the rules. And if it is below the threshold, then no need to go to the members. AS 18, there are also various type of transactions that are covered. It is a illustrative list. So it doesn't restrict it to just these 7 transactions, but it includes all sort of transactions where there is a transfer of resource. Similarly, in AS 24, again, all sorts of transactions wherever there is a transfer of resource. It is specifically mentioning equity contributions. Now, question is, if there is a rights issue that is done by the company, and every shareholder can participate in that rights issue, and my promoters who are my related parties will also participate in that rights issue. Now, is that a related party transaction under Ind AS 24? Ind AS 24 yes says yes, including loans and equity contribution. Question is, if dividend is declared by a company to its shareholders, some of the shareholders will also be promoters and related parties. So do I need to declare dividend in my related party disclosure? Is it a transfer of resource? The strict interpretation is yes, it is a transfer of resource, and many companies today disclose dividend as a related party disclosure. Now, once I've identified the related parties, I have identified what transaction is covered, then it comes to what is the compliance. And there are various compliance across various acts. The first and the most basic is disclosure. That disclose that in your annual report. SEBI requires listed companies on a every half-year basis to disclose related party. SEBI also requires to put it up on the website, which are the related party transaction, and Companies Act requires that your board report should also consist the disclosures of related party transactions. Now, some transactions, disclosure may not be good enough because disclosure gives me no ability to stop that transaction or contribute to that transaction. So in certain type of related party transaction, approval needs to be taken of those charged with governance, which is the audit committee or the board. Now that consent is linked to the quantum, whether it is in the ordinary course, whether it is at arm's length, and all those features come into play. Sometimes consent of those charged with governance or board or audit committee is also not enough. And it's such a material transaction that I need to go to the shareholders. There is again linked to quantum, again linked to ordinary course, arm's length, and also majority of minority protection comes in shareholders approval. Sometimes apart from shareholders approval, I may need to do an independent certification, like in transfer pricing we have, or in statutory audit in CARO, every auditor needs to certify compliance with section 177 and 188 of the Companies Act. So auditors would need to give an independent certification whether the related party regime has been complied or not. Similarly, company secretaries in secretarial audit would have that independent certification on related party transaction. If independent certification is also not felt right, law in certain situation prescribes that I will adjust or I will have a cap. For example, in tax, we have a lot of these thin cap rules which are there that interest can be allowed only up to 30% EBITDA. Or in Companies Act, we have a cap on remuneration of certain type of companies. Or SEBI says that to a related party, I cannot pay royalty of more than 5%. So that is a blanket cap. Even if independent certification says yes, shareholders say yes, even if there is a disclosure, I cannot enhance that cap that is prescribed by law. And another requirement in the pedestal is a regulatory approval. For example, managerial remuneration, or in tax, we have advanced pricing arrangements, where it is a related party transaction, but government is also affected by that, and they would like to have a regulatory approval to that related party transaction. And last but not the least is banning of such transaction, where section 185, as we know, loan to directors, is nothing but a fallout of a related party relationship, that I cannot give a loan to a director, and that is banned under section 185. Similarly, under insolvency and bankruptcy code, you have restriction in terms of you not being a resolution applicant if you are a related party. So depending on which act, depending on the quantum, size, and detailing, there are different compliances across various acts. Let's look at Companies Act, since we are talking about that. The first requirement comes from section 177, that every transaction, every related party transaction needs to go through the audit committee. Certain transaction, that is those 7 transactions, A to G, if they are not at arm's length, if they are not in the ordinary course, they need to go to the board of directors. Those transactions, if they are beyond a particular threshold, it needs to go to the members, that is the shareholders. And the shareholders will vote in a majority of minority fashion if it is a public company. There is a disclosure on an annual basis in the board's report that comes by section 134, and companies are required to maintain a register of transactions under the Companies Act, wherein all transactions with RPTs will be covered in that particular register. CARO, or the company's auditor's report order, requires auditors to which CARO is applicable to confirm compliance with section 177 and 188. And friends, when you are looking at 177 and 188 from a CARO perspective, please look at the rules that are linked to section 188 and 177, because those rules are actually giving much more guidance than the section per se. Compliance with accounting standards in terms of disclosure is what also Companies Act mandates. So this is the broad framework of Companies Act in terms of the compliances that it requires. Similarly, accounting standards, you have to disclose transactions with related party. You are also required to disclose outstanding balances, payable or receivable, with those related party, and the nature of relationships. For example, subsidiary, parent, entities in which promoters have significant influence, and those 4-5 category is the nature of relationship. And if it is a material transaction, you may also need to mention name of that related party with whom that transaction has been conducted. Last but not the least, SEBI requires that there has to be a materiality policy for related party transactions, and that materiality cannot be less than 10% of your threshold. SEBI says any material transaction, irrespective of whether it falls within A or G or not, has to go to the members. And in that shareholders meeting, no related party can vote in favor. Now, friends, there is a slight difference between what the Companies Act says and what SEBI says. Companies Act says that in a members meeting, related parties cannot vote. SEBI says that in a members meeting, related parties cannot vote in favor of that resolution. So if a related party wants to say no, then is allowed to do under the SEBI framework. But under the Companies Act, he is debarred from voting in that sense. Schemes with related party, amalgamation schemes, merger acquisition require majority of minority approval. Royalty just can't be paid to a related party. It's capped at 5% of the consolidated sales. And related party disclosures on a half-yearly basis is something that is required from a SEBI perspective. Friends, what I've done is this is the fulcrum of whatever we discussed today as far as RPT is concerned. And if we go through this waterfall will take us to the logical conclusion, both from Companies Act perspective and from the SEBI perspective. And we will spend time on this slide, which will make sure that all of us in our heads are clear that what is the compliance framework, and it's a simple flowchart once we'll go through that. And if you want to read more literature, of course, section 177, 188, and rules are always available for you to go through in detail. But step one, identify relatives, right? We saw that Companies Act allows us these relatives, which is that 7-8 categories, including HUF. And first you identify the relatives. From the relatives, we go to identifying related parties, and ideally make a list of the companies where you are acting as a private accountant, or if you are auditor acting as a public accountant in some companies, or auditor, make sure that your auditee company has a list of related parties, and why is it a related party, under which clause mentioned under that tracker. If that is available, only then you can map with the ledger to see whether there are any transactions with that particular related party. Now question comes is that what if there is no transaction and it is just a contract? It may happen that I have entered into a contract, but the actual transaction has not happened. Now that also is a related party transaction. So not only you will have to map the related parties with the ledger for making sure that the monetary transactions are covered, but also maybe with the list of contracts that has been entered with the company, or the resolutions that has been passed by the board of directors and audit committee, to identify which all transactions are related party transactions. The one in black that is marked over here is the identify the related party transactions. Once you have the related party transactions identified, remember friends, if you have an audit committee, every transaction will go through the audit committee, irrespective of size, irrespective of nature of transaction. Every transaction goes through the audit committee. If it is a listed company, now if your client or if your company is a listed company, then you have to identify the materiality. If it is a material transaction, go for a board approval and take a resolution of disinterested shareholders or majority of minority. So if you are a listed company, you will straight away go and then take a resolution of majority of minority. If you are not a listed company, then you need to see whether the transaction is falling under the 7 heads of section 188 or not. Because Companies Act applies to unlisted companies, and the 7 items are only covered as a part of section 188. Then you will see that if it is forming a part of that 7 heads, then you go to the next step. If not, go ahead and do the transaction. Because it is not a part of the 7, you don't need to go on this side. Go ahead and do the transaction once your audit committee, and if it is not falling within that 7, do the transaction. If it is falling within that 7, you need to check whether it is in the ordinary course of business, whether it is at arm's length. If it is in the ordinary course of business and at arm's length, no need for a board approval also. Yes, go ahead and do the transaction. But if it is not at arm's length, or if it is not in the ordinary course of business, call a board meeting and let the board of directors decide whether they want to approve a transaction that is not in the ordinary course and not at arm's length. If the board of directors then approve, but the transaction is material, we saw the thresholds against A to G. There are thresholds, 2.5 lakh rupee for managerial remuneration and all of that. If it is material, then you have to, and if the paid up capital of the company is more than 10 crores, then you need to go and take the members approval. If not, no need for members approval also, go ahead and do the transaction. So this one sort of waterfall will, if you do it properly, will walk you through in terms of the related party compliance framework that is there from a SEBI LODR perspective and from the perspective of Companies Act. So some loopholes over here or some scope for improvement which is there over here, friends, is that as far as Companies Act is concerned, if I am able to prove that the transaction is in the ordinary course of business and is at arm's length, then despite it being material, despite it being large, it will never go to the shareholders. Because once I justify yes over here, it will straight away travel and I can do that transaction. Because it will just go from here and go there. It will never come to this situation. So what is ordinary course? What is arm's length? Arm's length, there is just some guidance in section 188, which says that if it is a transaction between unrelated parties without any conflict of interest, then it is arm's length. Ordinary course is slightly more subjective in terms of what being ordinary course and what being not. And some guidance should be there in terms of ordinary course or not. Let me give you an example, which is a live example of an aircraft company. And that aircraft company wanted to set up a flight stimulation center for its pilots. Now the promoter went ahead and set up in his own private limited company a flight simulation training center for pilots. And a listed airline company is giving contract for training the pilots to the promoter's private limited company. Now whether it's in the ordinary course of business becomes a big question there. The argument in favor of the promoter is that, look, there is no flight stimulation facility available in that particular location of India where I need to train my pilots. And I need to do it at a level of expectancy that I have. At the same time, shareholders had an issue that, look, why don't you do it in this company itself? Why would you want to do it in a private limited company? So some of these questions are not black and white in terms of whether it is in the ordinary course of business or not, or it is in the arm's length or not. Many a time audit committees or board require independent CS certificate. That can you certify whether these transactions are at arm's length and in the ordinary course of business. And typically we have seen that such certificates from chartered accountants are based on arm's length calculation, which has linked to transfer pricing. Because transfer pricing has a lot of guidance and literature in terms of how arm's length needs to be calculated. There are various methods that are accepted from an income tax perspective. And I think that's a fair enough base to identify arm's length if a professional is going to certify. As far as ordinary course of business is concerned, And if you are certifying that, make sure that you understand or take guidance from the board what according to them is ordinary course of business. We have seen boards telling the chartered accountant that please make sure that to qualify for ordinary course, it should be an item that is allowed as per the main objects of the company, because then it is in the ordinary course of business. Make sure that such transactions have also happened in the last 2 years. Then it is an ordinary course of business. Make sure that it doesn't include 1% or 2% of the sales. Then it is in the ordinary course of business. So that kind of guidance will have to be given by the board, and basis of that, the certifying chartered accountant will then need to see whether some of these transactions are as per the main objects, have been done in the last 3 years or not, are at a particular size or not, and then give a certificate of what is ordinary course of business or not. But the buck lies at the audit committee. It is the board of directors ultimately who will decide in terms of whether a transaction is ordinary course or arm's length. One more issue, friends, in related party that comes is that if a transaction is done by my wholly owned subsidiary, so let's say there is company A, which is a listed company, and that listed company A has a 100% subsidiary, company B. Now, if company B is doing related party transactions with the promoters, as we stand today, it is not something that comes to company's A's board of directors, or it doesn't come to company's A shareholders. So company B, effectively being a 100% subsidiary, can enter into transactions, and maybe that is one of the abuses that in the recent SEBI committee paper that they are trying to protect. But as we speak today, if a subsidiary enters into the transaction, it may not fall under related party. Similarly, when we are identifying related parties, we saw that if a director owns more than 2% in a public company, it becomes a related party. Or if I'm a director in a company, then it becomes a related party. But what happens to a 100% subsidiary of that company in which I am a director or I'm a member? That doesn't become a subsidiary. So only first level companies where I am a director or where I am a member are covered under related party. The whole angle of subsidiary, which is where if someone wants to abuse the process, that is something where again there needs to be some guidance and some protection on. So I think, friends, we are at 4:40, and we'll spend some time for about 10-15 minutes on the questions. And this presentation, of course, is available, and I'll share it, and we'll distribute this. But I think the idea is that this particular slide will take us through the entire compliance roadmap. Thank you, friends, for that patient listening. Preeti Madam, over to you.
Yeah, perfect. Thank you, Anand. I request Mishra ji to please share the screen of questions.
So let's take the first question.
Yeah.
If dividends are waived off by certain shareholders, does provision of IEPF apply to the same, or said dividend can be utilized by the company? So the waiver, as it has been built in by some of the companies, is before declaration of dividend. You are giving an optionality or functionality to a particular group of shareholders that if they would like to waive off before declaration, then they can do so. Now, in that situation, if before declaring dividend, that functionality has been enabled, it will not be a declared dividend. If it is not a declared dividend, the provision of IEPF don't come in. This was also a similar view in dividend distribution that was held by some of these companies, but it will not be under IEPF if it is waived off before declaration. Second question, can a company declare interim dividend to equity shareholders without paying dividend to preference shareholders for previous years? Now, it depends on the terms of the preference shares, whether these are cumulative or non-cumulative. And some of these terms can be bespoke in terms of when dividend is due to a preference shareholders. But if it is a cumulative dividend, then also it will be linked to the final dividend declaration and not the interim dividend declaration. But when the final dividend is being declared, you will certainly need to give to the preference shareholders to the extent of the interim dividend that you have given to equity shareholders. So maybe in June, July, you can distribute interim dividend to equity shareholders without giving to preference shareholders. But when in September, when preference shareholders actually are due for their dividend, you will also need to give to preference shareholders the dividend that was given to equity shareholders. If a company declares interim dividend, preference shareholders have no say in interim dividend. At the end of the year, the company does not declare final dividend. Can it differ? So this is a similar question of what we spoke. In a final dividend, because interim becomes final for equity shareholders, preference shares will also need to be given that final dividend because equity shareholders have been given that. Question 4, query on dividend. How does it work when company law permits differential rights in dividend and voting rights, but under SEBI, which permits only voting rights? Would this restrict listed companies to give differential right as to dividend to shareholders? My sense is yes. You will need to comply with both because Companies Act as well as SEBI. And if you are a listed company, then you still need to make sure that your issuances of share comply with the Companies Act and comply also with the SEBI regulations. So you will be able to issue differential voting rights only. What is the quantum or percentage of dividend a private limited company may declare? Maybe say 10,000 per share of rupees 10 each, when the balance in profit and loss account is 100 times the paid up share capital. Any compliance or restriction? So declaration of dividend is completely the discretionary call of the shareholders, and majority of the shareholders can approve once the dividend has been recommended by the board. There is no compliance or restriction in that sense. But if you don't have, you have balance of profit and loss account, which is 100 times the paid up share capital, that is your maximum. But the board may decide that for future purposes, there is a requirement to conserve cash and it may not declare any dividend at all. There is no need for a mandatory dividend, unlike what we are seeing with CSR. We need to understand that Companies Act is not an act that is coming up from the charging provisions of the Constitution. It cannot levy a compulsory obligation on me to pay dividend to the shareholder. And that is also a constitutional challenge that CSR today is facing, that whether you can enforce 2% CSR on companies, but leaving that apart, it is not mandatory to declare dividend. Question 6, as you mentioned, a shareholder has an option to opt out of accepting dividend. Yes. My question is, why any shareholder would not accept a dividend? Is there underlying reason behind it? I think it can be various reasons. For example, let's say as a promoter, I am owning 70% of the company, and I may not want a dividend, because even if I get it, I may be reinvesting it back into the company. But for a minority shareholder, or if at all I want to have a dividend payout ratio, they may be expecting some dividend. So different shareholders may have a different expectation of dividend. Or sometimes you just want to compensate minority shareholders. Like, when the IPO of Reliance Power came in, post IPO, the price was so low that, bonus shares were declared. And in that bonus share, Anil Ambani as a promoter group did not participate. So they waived their right of getting bonus, because of which minority shares got bonus. So sometimes you want to reward minority shareholders. Sometimes you as promoters don't want to do. And for various reasons, you have a right not to accept, or you have a right to waive dividend. In case of a private limited company, the words used for related party includes members. Does it mean that each shareholder of a private limited company? Yeah, so if at all your director, that is the director of your reporting entity, is a member in any private limited company, then that private limited company becomes a related party. Other shareholders of that private limited company are not my related party. But wherever I have a director who is a member in a private limited company, that becomes my related party. Whether the board has to justify in the meaning that transactions are at arm's length and is required to be included in the minutes that the board has checked the transaction at arm's length, yes. So the board of directors will have to exercise their discretion and fiduciary duty to make sure that the transactions are at arm's length, and only then the transactions can go through. In fact, as Companies Act has been prescribes, if at all it is not at arm's length and not in the ordinary course, it even doesn't go to the board. But if it goes to the board, it is for the board to justify that it is at arm's length or not. There is also a code of conduct for independent directors under the Companies Act and SEBI LODR, and that requires independent directors also to make sure that transactions are in the arm's length and in the ordinary course of business as far as related parties are concerned. So board will have to justify. A company has two classes of equity shares with differential rights. When a dividend is declared to one class of share, then do we need to undertake any kind of declaration or waiver of dividend from other class of share? So as we spoke that if it is a listed company, then it needs to be consistent dividend across all type of shares which are there. But assuming that it is an unlisted company, then it will depend on the terms of the differential rights that you have. So if you have 80% of dividend to category B shares, then you will still need to pay 80%. If you are paying 100% to class A and 80% to class B, you will still need to pay. But the waiver is something different, where both classes of shareholders can waive their right to get the dividend. But whether you pay or not will depend on the terms of the differential shares that you have issued. Shares to be transferred to IEPF after 7 years, in whose name it will be transferred, chance to reclaim by the original shareholder. Yes, so there are IEPF rules and IEPF guidelines. Basically, this is a trust and the shares will be held in the name of the trust only. And yes, the original shareholder can go and reclaim those shares from the trust, but the company is not no longer then liable as far as the shareholder is concerned. It is between the trust and the shareholder.
Any still questions are coming?
Okay. Once company declared interim dividend, is it mandatory for the company to declare final dividend for the same year? No. If at all interim dividend is declared and the company feels that that is good enough, then the interim dividend itself will be the final dividend and no further declaration may be done in that particular year. If a CEO or CFO has no decision-making right, does the unlisted company disclose them as KNPs in the financial statements? Yes, because per se, if you are a CEO or CFO and that form has been filed with the ROC, you are a deemed key management personnel. And the fact that you actually don't exercise your decision-making right doesn't mean that you can absolve yourself of the responsibility. So the fact that you are a CEO and CFO, you will be a KMP and therefore being responsible for the compliances that come in relation to that.
I think questions are also covered. All the questions have been covered. So all will agree along with Vishal Bhai, Vice Chairman of the committee, that it was a marathon run, and Anand Bathiya has covered and all the both the topics in such a in very short span of time, in such a way, in simple and lucid manner. It was understood by everyone. He has also covered the question in very nice manner and clarified the doubts of the members who have questioned, who have questioned their queries. So on behalf of all the participants and WIRC, I propose a very well-deserved vote of thanks to Anand, and I request all to carry with loud applause, and Anand will definitely hear it.
Thank you, madam. Thank you.
Thank you very much.
Thank you.
Thank you, Anand bhai. And to all the participants, we look forward to another interviewing session tomorrow at 2 p.m. See you then. Till then, stay safe, stay healthy. Bye-bye.
Thank you, Vishal bhai. Thank you,
Bye.
everyone. Thank you.
Bye.